Greetings, welcome back to my videos, or the Hoop Scoop. I just wanted to make another video digging deeper into how to build a stable income portfolio. So in the previous video, I was just analyzing why the stock market is the best vehicle for investing and just comparing that to real estate and some other investment opportunities. Now, I'm going to dig into the stock market and how to build a stock portfolio. And again, this is going to be a little bit more general. I'm sorry, I'm not crunching numbers. I was thinking last time, I was like, oh, we can dig into some actual numbers and look at specific stocks. But I realized I don't think I covered some of the more general portfolio building concepts. And I want to make sure that I cover those for my wife and for anyone who is curious. Well, if I want to build a portfolio in the stock market, well, how would I do that? And why would I do that? And previously we looked at why the stock market is better than real estate for me and my wife, at least at this point, and especially if I were to pass away. So now I want to let's take a look at the stock market and how does my wife even go about starting that? But fortunately for her, I already have a portfolio that I'm building for us. So we do get $4,000 a month in cash flow from that portfolio. However, that portfolio is very actively managed by me. I have it set up with specific rules that I follow and I observe it on a daily basis. And my wife is a different person than me. She has different interests. She is not interested in looking at the stock market every day. And so the portfolio that she builds will need to account for that different personality, those different values, the different goals that she will have than what I have. So I just want to walk through and outline that process that she is going to need to go through without me if I were to pass away. So the first thing, you want to determine what your goals for the portfolio are. And if I pass away, the main goal is survival, raising our children, and providing well for them. And so the best way to do that I can see is building an income portfolio utilizing the cash from the death benefit. And remember, we have a death benefit in place for me of $1.2 million. And part of that is being allocated to life insurance as a stable base for growth, savings and growth. And that money, all the money allocated to life insurance is our savings / emergency funds. Now, this is similar to a concept called the barbell technique. We then take the rest of it and invest it in high cash flow opportunities. And that generates the cash flow necessary to live on. And it generates the cash flow, well, eventually, once we have enough cash flow, she can switch into growth. And so then we'll get both cash flow and growth for her and the children once she has enough cash flow to live off. So the why, provide for family. And then what you do to invest. We talked a little bit, we're putting the money into the stock market. And the way to go about doing that, the way it is structured, is you have to go through a broker. Only brokers are allowed to buy stocks directly. You can buy stocks directly from the company, but even if you're buying stocks directly where you directly own the shares of the companies you're buying, you still have to go through an intermediary that sells the shares on behalf of the company. And I'm forgetting the names of those companies. I think it's like several different ones you could go through, but it's very slow and it's kind of a hassle to manage your portfolio and sell. And nowadays, most brokerages, you can do that within minutes. So it's much easier to simply go through a broker. Now, the brokers that we use, right now we use Robinhood and Tasty Trade and Schwab. Those are the three brokerages that I have experience with. The brokers that I someday plan to use are M1 Finance, Fidelity, and Interactive Brokers. So those are all the brokerages that I like that have a very good reputation. For my wife, specifically, I believe M1 Finance and Fidelity are probably the best options. Mostly just because of the simplicity. Robinhood as well. So, and she already has a Robinhood account. So, those are the places where she can start with investing. And they have very simple interfaces. It's easy to trade and manage your positions. And Robinhood makes it very simple with recurring purchases. So, I love all of these brokers. Fidelity has an excellent reputation. M1 Finance has an excellent reputation. Schwab, good reputation. Interactive Brokers has some of the best margin trading capacity that I've heard of, and the most offerings of any broker I've heard of what you can trade. So now, Tasty Trade and Interactive Brokers are not friendly for beginners, especially Interactive Brokers. I would not recommend that for my wife because it's primarily focused around traders. And I don't know very much about their cash management tools, but their trading tools are phenomenal. So if my wife, for some reason, decided she wanted to become an active trader, Tasty Trade is much easier to use, and Interactive Brokers would be the advanced, like, hey, let's take this to the next level for active trading. But I don't expect that, nor do I think it's necessary. So Robinhood, M1 Finance, and Fidelity are probably the best bets. Now, as far as what to do for investing, for my wife, that will be taking the portfolio or taking the money from the death benefit and selecting a brokerage to place it in, probably Robinhood or M1 Finance. And then her next step would be selecting specific investments. And in the stock market, the beautiful thing about the stock market is that you get to pick what you invest in. There are thousands of stocks, hundreds of ETFs, all sorts of commodities. We've got closed-end funds, mutual funds, index funds, options, real estate investment trusts, CLOs, that's collateralized loan obligations, bonds, all sorts of investments to invest in. And all of these, well, with the exception of commodities, but all of these can create cash flow in some way. Of these options, I think probably the best and safest for her to focus on are going to be the ETFs, closed-end funds, index funds. You can't really create very much cash flow from an index fund, actually, but options and real estate investment trusts. Collateralized loan obligations can create good cash flow too, but they're a little bit risky, and I don't fully understand how they work. So, but they're very good for cash flow. The book, The Income Factory by Stephen Bavaria, does a really good job analyzing and explaining what to look for in a cash flowing investment when you're trying to invest for income and literally creating an income factory out of your portfolio. I love his book. Highly recommend for anyone who's looking to learn how to invest for income. Now, I personally have traded options for about a decade now, and that is where I believe you can create the most income. And the yield max stocks have certainly attested to that. They can generate yields in excess of 100%, which is mind boggling. It's also unsustainable since that requires the share price to double every single year just for you to keep the value of the yield max ETF stable or growing. Anyways, however, you are creating consistent cash flow, and there are plenty of other investment opportunities that do create consistent high distributions and can remain stable over time. Anything that uses options, any exchange traded fund, ETF, that uses options and pays under 25%. So there are several that pay anywhere from 8 to 20%, SPY T, QQQT, T-SPY, and such. They will remain pretty stable or flat, or even grow in share price, appreciate gradually over time. But if you have a stock that is distributing more than 25%, you are going to see that price gradually decline over time. That would be the net asset value. And the reason is just because as they're distributing income, they're making money, yes, through selling the options, but they also occasionally lose money when they're selling options. And if they're simply distributing the time value, not all of that time value is always captured as profit. And so some of it gets redistributed back to you, even if they didn't make money. And that's not a problem. There's always going to be time value. Time always has value. And so you'll be able to continue receiving distributions over time. But what it does mean is that in order to keep the net asset value of your position stable, you will want to reinvest some of the money at least. And that will keep your distribution the same, or it'll even grow your distribution over time. So one of my favorite investments is USOY, and that trades by selling put options on the price of oil. And that's absolutely genius. My intention for this is to use it to offset my fuel costs, especially when gas prices rise. So basically, all they're doing is they're holding cash. They invest the cash in short-term bonds, short-term treasuries, and then earn 4 to 5% yields on that. And then they turn around and they use that as collateral to sell a put and collect cash for the time value that's in that put. If the price of oil goes up, they keep all the cash on the put they sell. And then they distribute the time value of that and repeat over and over and over. If the price of oil goes down, they pay out the difference and they still pay out the time value. But some of the money in the treasuries needs to be redeemed to cover the loss when the oil price decreased. So absolutely fantastic fund. I wish more people knew about it, but in any case, that is a very, very simple example. It's a very simple strategy, and it has performed pretty well, for me at least. Right now, we're getting about $200 a month in distributions, and my monthly fuel cost is around $400 to $500 a month is what I spend. So I'm about halfway to covering my entire cost of fuel. So just through dividends, which is fantastic. So Back to the investments. Sorry, I got a little distracted. Got excited talking about a specific investment. In any case, of these different investment options in your brokerage, stocks, ETFs, closed-end funds, and real estate investment trusts and bonds are generally the most stable and best options for creating cash flow in a portfolio. And any fund that uses options will give you a nice boost to that cash flow. So there are funds that hold bonds and sell options on bonds. And that creates very nice boost in cash flow. There are funds that hold stocks and sell options on the stocks. Nice bonus to cash flow. But you are giving up the upside to some degree or another. So you will not generally see these funds perform as well as if you had simply bought the stock or the market or the index. That's okay. Right now, the goal is creating cash flow so that we can provide for our family in the future. Well, in the present and the future. And then, once we've achieved that cash flow we need to cover all expenses, then we can just buy the growth indexes. And then we get both growth and cash flow. We're not in a place where if something happens to our jobs, we're in a pinch and don't know how to pay the bills. That's the goal. Now, as you find different investments to invest in, you will need to determine how you want to allocate to those investments. And typically, you want to allocate based off of your risk tolerance and your portfolio goals and needs. If you want a lot of cash flow, if you need a lot of cash flow, I should say, allocating to a high distribution investment is going to achieve that goal. But the higher the distribution, the more volatile the value of the portfolio will be. And as you get those distributions, you'll see your portfolio value drop when they withdraw the cash for the distribution. And then when it gets distributed, the portfolio value will go back up. But if you pull that cash out to pay expenses, that portfolio value is going to decrease again. So it's a matter of, okay, we're allocating to high cash flow, and we need to make sure that we're reinvesting some of that cash flow to keep buying shares and growing that cash flow. And at the same time, we want to draw some of that cash flow. Sorry about the airplane. Airplane just flew above me. We want to withdraw some of that cash flow to pay for our bills. So some goes back to create cash flow, some goes to pay bills, and eventually when you have enough cash flow, some goes to purchasing growth investments as well. Now, diversification is important, but an exchange-traded fund, an ETF, can typically provide you with a lot of diversification. The exception is ETFs that have exposure to a single stock. Those ones are much less diversified, and you want to be careful with those. Typically, you probably don't want more than 5% of your portfolio allocated to a single stock with like single stock risk. So if there's a company you really believe in, 5%, that's a very big investment. That's 1/20th of your portfolio into that ticker. Right now, we have 9 different positions in our portfolio. And my portfolio is structured for high income. And so we have very big fluctuations in the value of the portfolio, but we also have increasingly high distributions. We've gone from, in less than a year, zero passive income to $4,000 in passive income. So very high distributions, but very volatile portfolio. And the goal should be, okay, once we hit that income target, now let's smooth out the fluctuations in the portfolio by reinvesting some of it into lower yielding but smoother assets. And so this is just part of the process of figuring out how much you want to allocate to what and the timing for that. And then with my wife's portfolio and how she will need to manage it, because she is not building her portfolio from scratch with zero money, and instead she'll have close to $1 million to allocate. She does not need to go for the super high volatile cash flow. She can pick from much more stable cash flow sources. And so she won't need to go for the 50% yielders or 70% yielders to focus on increasing cash flow. Instead, a stable 20% yielder or even a 12% yielder that has some growth as well is all she needs. So then you want to track your exposure to that underlying and compare it to that other investments that you have. And so if you have several investments and you see that they all invest in the S&P 500, you have much more S&P 500 risk. And so for your next investment, perhaps you look to invest in something like oil in USOY, which has no exposure or very little exposure to the S&P 500. Or you look to invest in some real estate, like real estate investment trusts, where they manage it for you through the portfolio. So, and then that whole process is just determining what risk that you are willing to own in your own portfolio. And then as far as managing the portfolio, over time, the value of the different parts of the portfolio are going to fluctuate. And you just want to figure out how much you want to own. And as you learn more about the different risks you're exposed to, you can increase or decrease those allocations to those investments. So, and as you pick and choose, you just gradually move funds from one to another. And you have to make the decisions. There's no way to know, is this the right decision now? You can only build a case for it by looking at the facts that you have in front of you and your knowledge of what it's done in the past. Hope that it'll continue doing that. And as you measure the results going forward, you can make adjustments. You're never locked into an investment. You can always pull your money out. Never give into the sunk cost fallacy. So, yep. And then last but not least, keep on keeping on. Keep learning about the different investments in the portfolio. Learn a little bit about options. Just keep reading. Seeking Alpha is a great place to read about different investments. Don't let any one person's article scare you out of an investment, but do try to read both sides so you can understand the pros and cons. And track your goals for cash flow, for growth, for performance. Compare how it's performing compared to the market and compared to where your portfolio was in the previous year. And then you just reinvest and reallocate accordingly. I believe that's just about all I have for now. So that's a generalized idea of what you want to look into, what you want to think about when you're building out a portfolio. And then I'll try to dig into more detail, especially on different brokers, the pros and cons, and different investments to help provide some clarity for what are the best options in 2025 for cash flow, stable cash flow for my wife if I were to pass away. So thank you very much for listening. Feel free to subscribe and follow for more. And I'll start working on those videos next week. Have a great day.